Hello, everyone. You're all very welcome to our weekend markets, a weekly roundup for the price action for this week gone by. So we've had a very, very volatile week, both up and down. But of course, after the CPI data that came out yesterday, we have seen the markets rally into the close as the cash markets closed for half day today because of Remembrance Day, and the markets look to piggyback on some of those moves that we've seen over the last couple of weeks off the back of those weaker CPI bottoms that formed middle of October, and is trying to close out, obviously, as we said, stronger this weekend into the market close. So I suppose firstly and foremost, if we look at the economic calendar to begin, we can see here, yes, that the big catalyst on Thursday was, of course, the weaker than expected CPI figures. So, of course, the lower the CPI figures were, the better it was for the stock markets. And as we looked in on Thursday, we talked about the idea of the different expectations by different institutions. And of course, the CPI figures beat all expectations. So CPI figures, overall CPI came in at 7.7%, which was lower than the expected 8%. And of course, with the lower CPI figures meant that there was an aggressive move in the stock markets as sentiment continued to shift in line with investors. And we saw those gradual continued declines in the stock markets. And of course, that weaker dollar sell-off, it resulted in the back end accordingly. So, of course, what does that mean? Well, it means that the CPI figure from last month is 0.5% lower compared to where it was just a month ago. And of course, the month-on-month figures, when you look at the month-on-month figures, they were actually stable as well. So despite the increases in the energy prices, in the oil prices, broadly speaking, we have also seen the fact that the CPI figures have come down year on year, which is basically illustrating now that these higher interest rates is now starting to come into effect from a fundamental, broader market perspective, not just from a short-term price action movement, but in the much grander, broader perspective. We're now starting to see a little bit of an impact of the higher interest rates on inflation, and obviously the ability to implement and maintain stable prices. So where does that leave us then? Well, that obviously leaves that with the CPI figures coming down, that's obviously a massive plus for the Fed in terms of policy, but also in line with other central banks. So hopefully now with the higher interest rates globally, whether it's the UK, whether it's Europe, Australia, Canada, etc., we're hopefully starting to see an impact on those higher prices that we've been witnessing over the last 12 to 15 months or so. And we're starting to see a top out in those prices, and as we start to see prices normalize and come back to more realistic levels. So where does that leave us then? Well, that leaves us then with a very, very sizable move in the stock markets. But before we look at the indices, let's look at the dollar play. Let's look at gold as well, and we'll break through all of these assets one by one. So structurally speaking, if we start off tonight, the big talking point has been, obviously, of course, in the last couple of days, that continuation in dollar weakness. So dollar was in this kind of flagging structure. And of course, with that massive impulse yesterday, we have seen dollar weakness play out yesterday. We've seen that bias very much continue today as the dollar markets has sold off. So with that dollar weakness, the sentiment, the correlation in the markets. So generally, we know the stock market performance on one side, the dollar performance on the other, they're negatively correlated. So that means when one moves higher, the alternative one moves lower in the back end, and that's exactly what we're seeing. So as the stock markets moves higher, we're seeing that weaker dollar play out, and across the board, you will be illustrating those higher moves against the dollar. So euro dollar, for example, if we look at the higher time frame for a moment, you can actually see very, very clearly that massive ramp up from yesterday right through taking out the liquidity from the early parts of September as markets correct. And that is really kind of proposing the idea of, are we going to see a rally in the stock markets into year end, given the volatility associated with the midterm elections on Wednesday, and by and large, the overperformance by the Republicans against the Democrats. Now, of course, we talked about it on the different permutations in our discussion group, or in our Discord community group, should I say, on Monday and Tuesday ahead of the results. So, of course, now we're seeing that pricing in. And, of course, on Tuesday, we do also have the potential announcement for President Trump to be named as the Republican candidate for 2024 election. So we'll start to see that really evolving over the next 12 months or so. So worth keeping an eye on that narrative as well. So As we said, then euro dollar has been absolutely through the roof. Cable has been same. Anything against the US dollar has seen massive movements over the last couple of days or so. And of course, we're seeing that play out in the FX markets as well. So euro dollar is back into this 103 level. It's the first time we've seen it at 103 since the back end of the summer. So since that August and September sell off into those October lows, we have actually seen the euro dollar return to those price points around this 103, 103.50 level. And it just becomes a case of now, how deep is this rally in favor of risk-orientated assets against the USD going to extend to? And of course, at this moment in time, yes, we're kind of taking out the higher echelon levels here in the daily around 103, 103.50, but there is a lot of upside, because when you look at the broader trend, we have for the last year or so consistently been making lower lows, lower highs. The broader trend has favored the dollar outperformance against everything else in the FX markets. And now we're starting to see that shift in that dynamic. We're starting to see that shift in sentiment. And of course, now we're starting to see those long recoveries in some of those FX pairs as well. So let's see how this one plays out. But at this moment in time, obviously, the euro is piggybacking off of the dollar weakness, which has meant that euro dollar is continuing to churn higher. And of course, that evolves right through into some of these other assets. So we're seeing cable rally up. So where we were just a couple of weeks ago, kind of 111s, 112s, even from where we were last week, from our previous video last weekend, where we were finishing up here around 115, we have seen the markets continue to churn higher. Obviously on Thursday, massive movement. Friday, it's continued to turn higher. And now the price point of the realization that the probability is that the pound is going to continue churning higher back into this 120, 122 level. And that is a very, very stark change of bias and change of sentiment, considering where we were just a few weeks ago, right? Less than 4 weeks ago, 5 weeks ago, we were talking about the pound crashing and potentially going to parity. And now all of a sudden, with the change in sentiment, the lower than expected CPI, the weaker dollar, the recovery in risk-oriented assets like the stock markets as well, we're seeing obviously the cable fly back up. So now it's just become a case of how far is this going to go? But the logical scenario, it'll be short term. It could very easily settle somewhere between 120 and 122. And of course, given that we're now moving progressively higher from where we were on Thursday at 113.50, 114, all the way up to 118.50, that shows a 400 to 450 point move in just 2 trading days, which again reiterates the volatility that we're seeing in these markets at this moment in time. Now, if we look at euro dollar, we're obviously looking at cable. Or of course, we're going to look at dollar yen, because that has been a monumental move in the last couple of days. And of course, what have we seen? We've seen that U-turn. 149 was the key level. We had obviously a level down here around 145, 146's involvement. But very, very clearly this week, dollar yen has completely sold off. It's been completely obliterated. We had that pause last week at 149s, which of course was a level of interest we've talked about in previous videos over the last number of weeks. And we've seen that very, very clear sell-off from this 147 level all the way back through 139. So again, that's a 700-800 point decline this week. And given the yen weakness we've talked about in previous videos, we're obviously seeing that become even more exacerbated with the volatility in dollar yen. So that weaker dollar has really aided that yen movement. And of course, we've filtered through from 146, as I said, back to 139, or even earlier than that in the week at 147, back through to 139. So we're obviously looking at now this order flow, higher highs, higher lows, this next corrective move. And it really just becomes a case of how deep does this extend. But at this moment in time, with the weaker move in the dollar, we could very easily see a 105 handle on the DXY, which would even allow for deeper declines back to this kind of 134, 135 level, which only assists Bank of Japan's policy of trying to tackle this overwhelming dollar strength against Japanese weakness in these markets. Now, of course, with that aside, we're also going to take a quick look at the Aussie. And as well, as you can see here in the Aussie, we've had this massive trend play out over the last, let's say, 5-6 months or so, from April right through to November. Very, very clear sell-off. But now we're getting that recovery. Okay, we had that local high at 65 we kind of talked about last weekend. We have very, very clearly broken through in the last couple of days or so. Obviously, yesterday being the catalyst, we're continuing to see that extend higher. So we've gone from kind of 64, 65 range right through 66 up onto 67, and we're looking at this to continue. Now, when you look at local swing highs to local swing lows, you can see here as well that there is the potential for this to come even higher. And I suppose the earlier point of view that I was chatting about was 67 being a possibility. Well, we've actually got to 67 now. This area, short-term area of liquidity here in the daily, has now been mitigated, but now it's a case of, can we extend even higher? And if so, the likelihood is you will probably see Aussie dollar with the support of stronger indices and on stronger other risk orientated assets, you'll probably see that settled somewhere between 68.50 and 69. And that is an area of worth keeping an eye out on next week to see, does this sentiment continue? Because if it continues with the speed that it's going at, then the likelihood is you're probably going to see that settle up there as well from a higher time frame perspective as well. All right. So that's the FX markets. Of course, with that, then we're obviously looking at the gold markets. And of course, gold, not unlike some of the others, has continued to churn higher. So when you look at this larger Wyckoff accumulation structure, we had that massive reversal off the back of this Russia-Ukraine invasion or war. And then we've seen since then commodity prices largely fold off. So since then, gold has been very much in decline, 20% decline, obviously against the dollar, with that stronger dollar through the last 6 months or so, or 9 months or so. And of course, then we've gone from 2000 all the way back into the 1600s, but now we're correcting again. So with that weaker dollar, should I say, over the last couple of days or so, that has really aided the progression in the upside for gold prices. And of course, we've taken out this area of liquidity. This 4-hour structure we talked about last week around 1720 was very quickly taken out. And I suppose the big thing that we talked about in Thursday's CPI preview, that the initial observation was that at least off the CPI figure, you were going to get a $20 to $30 move. But as it turned out, we actually got far more than that. So we've gone from that 1710, 1715 level all the way up to 1765. So really, since kind of Thursday, we've actually got closer to a $40 to $50 move in gold, which again reiterates the volatility. And of course, the price action is still continuing to churn to the upside. So at this present time, you would expect gold to probably get back into this order flow liquidity area here between 1790 and 1810. And that's really what I'm kind of looking at now over the next week or so personally, to see, can this continuation in cycle reversion out of safe haven assets into riskier assets allow for that continuation to the upside? And that is worth kind of focusing on into obviously the close this week, and of course into the early parts of next week as well, broadly speaking. So that then brings us then from gold into the stock markets. Okay, so we're seeing the evolution of sentiment very clearly unfold here in the indices. So we've had this gradual kind of higher high, higher low scenario play out in the S&Ps, and since then, since Thursday, we've had that massive run up. So we had that very, very strong close on Thursday, taking out the structured highs from the early parts of November. We're still seeing this kind of short term, I suppose, if we look at the 4-hour corrective structure here, you can see very, very clearly how we're getting that continuation in higher highs, higher lows. We've got the short-term higher highs, higher lows after the mid-October reset, or I suppose the reversion of directional bias, if you want to call it that. And we're still seeing these higher highs, higher lows. So on the daily time frame, when you look at the broader picture, we're starting to climb again. Okay, we had that very, very clear decline. If you look at all year long, the decline in the S&P is so very, very clean. Lower lows, lower highs consistently. Every time we get a decent low, we tend to get a decent correction with that. And at this moment in time, the S&Ps is actually working its way back into some of these declines that we saw through August and September. And for me, the first level of interest really becomes this daily area of liquidity, which was the sparking sell-off from the middle of September into obviously the middle of October. So that obviously is the number one area that price action is looking to get to, let's say over the next week. And that brings us up to around this kind of 40.050 to 40.100 level, and the daily order block is coming in at around about 40.65. So if you were to look at a 4-hour chart, you can also see that 4-hour area just extends to just above the 40.100 level, and that really now becomes the point of interest to see, can the price action take out this area? Because if it does, it could actually spark a deeper recovery into the end of the year as well. Now you're probably wondering, well, from a fundamental perspective, why is the stock markets moving higher? Given the recessionary risk, given, I suppose, the associate risks off the back of the political side of it as well. And the big thing to talk about there is, yes, a lot of these sell-offs, like you have to imagine as well that the goal at the end of the year was always to be around about 4% or maybe even higher than that in interest rates set out from February, March. That's what a lot of analysts has been looking at. And a lot of this has been priced in. But you also have to factor in now, we're starting to see a weaker CPI. We're starting to see a little bit of a tilt in sentiment in terms of directional bias. And also there's two other narratives, right? The recessionary narrative generally occurs. So you tend to see a bottoming in stock markets approximately 6 to 9 months before the recession is actually felt in the economy. Okay. So everyone's talking about this pending recession or whatever. So that obviously gives another contemplative thought to the actual overall process. And the second thing is that in the midst of the midterm elections, on average over, let's say, the last 30 to 40 years, we actually tend to see the stock markets rally over the next 10 months or 12 months between 8 and 12%. So if you look at a 10% rally in the stock markets, that brings from, let's say, where we are here, 3,800, that's another 380 point increase on average over the last 40 years if you were to apply the percentages to that. And that would put the S&P somewhere up now kind of closer to 41, 4,200. And that's what's exactly kind of playing out now. But of course, it's a long way to go. 12 months is a very, very high time horizon to be able to gauge any sort of sentiment in the markets at the minute, particularly given how quick the dynamic can change. So of course, obviously from a broader perspective, I suppose these grinds higher is looking to continue over the next week or so. But of course, let's see how does that reflect. So from my perspective, this 4050 to 4100 level is very interesting short term. But of course, then if we can accumulate a break above that, or get a confirmation break above that, and then you're really looking at a return back into the 4300s. And then all of a sudden the recovery or the sell-off into the recovery looks a lot more favorable for those investing in the stock markets broadly. Okay. With that as well, if we look at it now on Thursday, we obviously talked about how the Nasdaq was heavily affected, or was the most heavily affected out of the three because of the weaker movements. Now, of course, what happened yesterday, we got that close very, very close to this 11,650 level we talked about which was the kind of October and the early part of the November highs. So you've even got early October highs, and you've actually got November highs up here as well, around 11,650, and we've ultimately catapulted through that as well. So this area of liquidity has been taken out, the price actions has broken through, and now we're continuing to progress higher. And it really just becomes a case of how far is the Nasdaq going to recover, considering it was the lagging indice over the last, let's say, 2-3 weeks, given the earnings season, how poorly the tech stocks done. Like Apple done okay, but then you had Microsoft, you had Amazon, you had Meta, a lot of poor performing numbers in some of those quarterly reports, and that's what left the Nasdaq lagging so much. So when you look at this now, there's a long way up for the Nasdaq, because you could actually conceivably see the Nasdaq recover as high as 12.6 or even back to 12.8, and even as well, that's another 1,000 points from where we currently are. So we can see now how the shift has gone from lower lows, lower highs to accumulation, bottoming out of structure, and now we're starting to see that cyclical reversion and trend back to the upside. So it's just about being aware of that as well in the back end. So the bias now has gone from selling the rallies to new lows to now being a short term, or kind of a short to medium term bullish corrective trend. And the sentiment now is probably going towards buying the dips back into those previous levels, which we said, which could be as high as 12.6 or even 12.8 on the Nasdaq. So that is something worth keeping an eye out on over the next weeks. Now, that's not to say it's going to get to 12.6 next week, but of course, it's very much going to help in the face of what's been a very, very difficult month or so for the Nasdaq off the back of the earnings season. So of course, with that as well, what have we seen? We have seen the Dow Jones also continue moving very, very aggressively. So of course, yesterday, we obviously saw that very, very sharp impulse on Thursday. Today has been a lot less favorable. Okay, so today has been a lot less favorable. Why is that? Look how far the Dow Jones has extended, right? So I would expect, given the Dow Jones has outperformed the Nasdaq and the S&Ps over the last few weeks, I would actually now expect the S&P and the Nasdaq, from a percentage weighting perspective daily performance, I would actually expect them to outperform now, because we tend to see when stock markets rally, the Dow Jones actually lags the S&P and the Nasdaq, and we saw that from the COVID recovery in 2020 to the end of 2021. Nasdaq was up 150%, S&P was up about 125%, and the Dow Jones was up about 105%. So you can actually see, in relevance to the other two, it actually underperformed. So when the markets recover, you actually tend to see the Nasdaq and the S&Ps perform better than that of the Dow Jones, and it's worth being aware of that, considering how much the Dow Jones has already extended against where we are with the Nasdaq. So when you look at the Nasdaq in comparison, very, very quickly, it's only just breaking through those end of month October highs, whereas realistically, the Nasdaq is way, way, way up here. So Nasdaq is actually down here in comparison to where the Dow Jones is, and that's really the simple message with all of this. Now, with that as well, what are we seeing on the FTSE? So the FTSE is getting a little bit of interest for myself, and just to kind of put the broader perspective on it as well, The FTSE, again, another thing that I've been kind of looking at now is the corrective nature in the FTSE in the UK. We've gone from this fake break through 6,800 all the way back up into this daily order block level at 7,400. And we've rejected that very, very cleanly here in the UK market. And I suppose the other thing I would say is when you go from swing low to swing high, or the most recent swing high to the most recent swing low down here at 6,700, you can actually see how we've catapulted all the way back through the fib retracement levels, which is kind of from a liquidity, price action, order block perspective, is what you tend to look for. And in the back end, you can also see how the markets have, after we've broken through this structured high, very, very clear flagging, trending price action structure, highs to lows, all the way back into this level here, this daily order block zone, which, as I said, was mitigated, of course, yesterday, or very, very late last night into early this morning at 7,400. Now, we haven't quite come to the 4-hour area here at 7,460, which is still a potential option. But when you look at the shorter time frame, you can actually kind of see how on the 1-hour structure, when we zoom in, you can see how the price action becomes very flagging, like with short-term highs, short-term lows, short-term highs, short-term lows, if you exclude the wicks. And then we get that last impulse before we break structure. So you can kind of see now how we've broken through the structure, and it looks like we're creating that short-term V bottom for one last pump into the upside. So my directional bias here is, yes, the FTSE has moved with the other indices. It has done better over the last few weeks than the likes of the Nasdaq, than the likes of the S&Ps. So are we coming into a peak formation structure? That is something to keep an eye out on next week, and something I'm watching closely myself personally. So that then brings us lastly then to the Dow Jones, or sorry, not to the Dow Jones, to the DAX. And the DAX has been very strong over the last few weeks, particularly of how weak it's been. Again, similar to the Dow Jones, very, very sharp sell-offs, but a very, very strong recovery. It's taken the liquidity out from those August highs. So it's taken September out, it's taken August, and it's approaching this region where we were in June. So this area of liquidity around 14.5 in June is ideally now where I'm looking to see is there kind of a reaction from. So we're kind of a couple of 100 points still away. But you can kind of see here we've got the first impulse, then we've got that second impulse, this very, very clear reversal, and price actions flagging back into this zone. So from my perspective, the area around 14,500 becomes exclusively very interesting over the next week or so to see if there's any sort of reaction, given the current state of the price action, and obviously given the state of this sell-off, because we've obviously structured, very, very clear decline, consolidation, then break structured lows. Now we're flagging back up to this area here at 14.5, and that is obviously something worth keeping a close eye on over the next few weeks to see if there's any sort of reaction from this 14.5. Otherwise, we could actually see a deeper move. We could actually see a very, very strong impulse back into 15,000 if this 14.5 continues to elevate upside versions of price action. So that's effectively where we are as well. So for those of you who are interested, of course, just to do some housekeeping, we have got the competition running. I think all entries now are pretty much closed for November. For those who have bought challenges, you will be entered into the free draw for the Mac, for the MacBook Pro, the computer, laptop, software, technical, obviously application. So we're obviously looking at that very, very closely as well for the competition, and of course the free giveaway at the end of November. And with that as well, we also have the website giveaway, or the launch of the new website has now been confirmed. And of course, that is something that we're very, very excited here at Alpha Capital as well. So obviously, everyone have a great weekend. Trade safe. I hope you've had a great week. I hope you've made plenty of profits. And of course, we'll be back next week for another video. Have a great weekend.